Welcome to this explainer, the psychology of money, behavior over math. We're going to dive straight into a concept that absolutely changes how we look at our bank accounts, our investments, and really, our whole futures. We're looking at Morgan Housel's incredible insights, plus some recent behavioral finance research to explore a totally counterintuitive idea. And that idea is that financial success, it's not a hard science. It is a soft skill. It's governed by human emotion and behavior, not just raw intelligence or complex math.
Why do geniuses go broke while everyday people become millionaires? Think about Ronald Read. He was a humble janitor and gas station attendant, lived a super quiet life, yet amassed a fortune of millions, most of which he actually left to charity. On the literal opposite end of the spectrum, you have Richard Foscone, a Harvard-trained finance executive who had this wildly successful career but ultimately went bankrupt and lost everything after the 2008 crash. I mean, you'd never see a janitor outperform a top nuclear engineer at building a reactor, right? No way. But in investing, this actually happens. And it happens because doing well with money has very little to do with how smart you are and a whole lot to do with how you behave.
Survey shows 60.8% of people balance logic and emotions in financial decisions. This data from the International Journal of Financial Management and Economics is absolutely fascinating. It shows us that over 60% of people are balancing logic with their emotions and intuition when making money moves. Only about 23% rely on pure logic. This proves that just having the right data or the perfect color-coded spreadsheet simply isn't enough. Our choices are heavily driven by our psychology, our fears, and those deep, intuitive gut feelings. At the end of the day, we are humans, not calculators.
The lenses we wear. This brings us to a really crucial realization about human behavior. It's so tempting to look at someone else's money choices and think they are completely out of their minds. But the truth? Nobody is actually crazy. Instead, we all wear completely different psychological lenses, shaped by our incredibly unique personal histories. Someone who grew up in poverty is going to think about risk and reward in ways that a child of a wealthy banker literally cannot fathom.
What stocks did in your teens and 20s, based on your birth year. Consider what the market was doing during your formative years. If you were a kid born in 1970, you saw the stock market increase almost tenfold during your early adulthood. It was an absolute wealth-generating machine. But if you were born in 1950, the market went practically nowhere during those exact same years of your life. The dumb luck of your birth year drastically alters your lifelong worldview on risk and participating in the market. 78.4% of people consider previous experiences when making important financial decisions, and the data absolutely backs this up. A massive 78% of people admit they rely heavily on their previous experiences when making major financial decisions. The economic climate of our early 20s totally anchors our lifelong habits. Think about it. Your personal experiences with money make up maybe a tiny fraction of a percent of what's happened in the global economy, but they make up 80% of how you think the world works. So your neighbor's seemingly crazy investment strategy, it probably makes perfect, rational sense through their unique personal lens.
Luck, risk, and ruin. We love to study extreme success stories, right? The billionaires, the massive CEOs, and we assume 100% of their outcome is due to their brilliant effort. But luck and risk are essentially two sides of the exact same invisible coin. They both represent this reality that every outcome in life is guided by forces completely outside of our individual control. They are so intertwined that you really can't believe in one without equally respecting the other.
Getting wealthy versus staying wealthy. The crucial point here is that acquiring money and keeping it require completely opposite mindsets. Getting wealthy requires optimism. You got to put yourself out there and take calculated risks. But staying wealthy, that requires a healthy dose of paranoia and frugality. It means accepting that what you've made can be taken away in a flash. This is exactly why we shouldn't blindly idolize extreme success stories. Often, those massive successes might just be the result of a lucky coin flip, rather than a repeatable strategy we can safely copy.
Margin of safety. Planning on your plan not going according to plan. To survive the reality of risk, you need a margin of safety. This isn't just some boring finance jargon. It's essential psychological and financial padding. It literally means planning on your plan not going according to plan. The trick is arranging your life so that one bad investment or one missed goal won't completely wipe you out. Avoiding total ruin is the ultimate goal here, so you can just keep playing the game until the odds fall in your favor.
35.3% of respondents admit to making a financial decision out of fear. Avoiding ruin is so vital because, let's be honest, our emotions often betray us. Studies show over 35% of people admit to making a financial decision directly out of fear, like panicking and pulling money out of a falling stock or refusing to invest at all because it just feels too risky.
When we let fear take the wheel, we tend to yank our money out at the absolute worst possible times, completely interrupting our long-term growth.
The magic of compounding, which brings us to the ultimate financial superpower. Now, we usually hear about compounding purely as a math term, but it is fundamentally a broad life principle. It's the result of small, consistent habits running steadily over very long time horizons. Linear thinking is what's intuitive to us, so compounding often feels surprising. We just aren't naturally wired to grasp how quickly things can snowball when you simply leave them alone for decades.
Warren Buffett versus James Simons. Let's look at the sheer power of time in action. Take Warren Buffett and compare him to James Simons. Simons is an incredible mathematician and a billionaire hedge fund manager, and his annual returns are actually 3 times higher than Buffett's. Mathematically speaking, Simons is the superior investor. Yet Buffett is significantly wealthier. Why? Simply because Buffett has been consistently compounding his money for 3/4 of a century. He started decades earlier. Good investing isn't always about hitting the absolute highest returns. It's about earning pretty good returns that you can actually stick with for the longest possible time.
The first rule of compounding is to never interrupt it unnecessarily. Buffett's longtime partner Charlie Munger really hit the nail on the head here. The secret to this magic isn't finding the next hot crypto coin or day trading perfectly. It's enduring through the incredibly boring or sometimes absolutely terrifying market moments without touching your money. It's letting time do the heavy lifting for you while you just step back and leave it alone.
The goalpost and enough. But here's the catch. Compounding won't bring you a shred of actual happiness if you fall into the trap of the ever-moving goalpost. This is where the psychology of money gets deeply personal. Modern capitalism is fantastic at generating 2 things in massive quantities: wealth and envy. The hardest financial skill to master isn't some complex trading algorithm, it's getting that goalpost to just stop moving.
Enough. Realizing that an insatiable appetite for more will push you to the point of regret. Having enough doesn't mean you're being overly conservative or leaving opportunity on the table. Enough is the crucial realization that an insatiable appetite for more money, more power, more prestige will inevitably push you straight to the point of regret. When you don't know what enough is, you end up taking greater and greater amounts of unnecessary risk to catch a horizon you will literally never reach.
A rookie baseball player versus Mike Trout. Social comparison is the real villain here, and it's a battle you can never, ever win. Think about a rookie baseball player making $500,000 a year. By any normal standard, he is incredibly rich, but if he compares himself to his teammate Mike Trout making $36 million, he suddenly feels broke. And if Mike Trout compares himself to a hedge fund manager pulling in his entire yearly salary in a single hour, Trout feels broke. No matter how rich you get, there is always going to be someone higher up the ladder. The only way to win the game of social comparison is to just refuse to play it.
Things never worth risking for more money. Reputation, freedom, family and friends, happiness. To protect what truly matters, we have to define our sense of enough. Because there are certain invaluable assets that are never, ever worth risking, no matter the potential payout. Your reputation? Invaluable. Same goes for your freedom, your independence, your family, your friends, and ultimately, your own happiness. You can't put a price tag on those. We have to recognize when it's time to stop taking risks that might damage these pillars just to boost our egos or get a little bit richer.
Saving as a superpower. This brings us to a massive reframe in how we view saving money. We usually see saving as a mathematical chore, right? Something we force into a spreadsheet. But really, saving is the ultimate psychological tool. Building wealth has far less to do with your income or your investment returns, and literally everything to do with your savings rate. And your ability to save is largely driven by humility, keeping your lifestyle below your ego.
Save for a world where curveballs are common. Most people think you need a specific reason to save. A down payment, a vacation, a new car. Actually, scratch that. You don't need a specific reason at all. In fact, saving without a goal provides the best possible hedge against life's inevitable surprises. You're saving for a world where curveballs are completely common. Savings that aren't earmarked for anything in particular give you flexibility. They give you the ability to wait for the right opportunity, and that critical margin of safety to absorb a shock without your whole life falling apart. Money's greatest intrinsic value is its ability to give you control over your time. Because ultimately, the highest dividend money pays isn't a luxury car or a massive house. Money's greatest intrinsic value is its ability to give you control over your time. It's the autonomy to completely change careers if you burn out, or to wait for an incredible opportunity instead of taking the first desperate offer, or simply the ability to take a Tuesday off when you're sick without stressing over bills. Wealth is what you don't see. It's the unspent money that buys you options and buys you freedom.
Practical takeaways. As we wrap up this explainer, let's lock in some practical takeaways you can apply today, no matter what your income looks like. First, prioritize your emotional behavior over raw intelligence. Recognize those biases and try not to act out of panic. Second, give luck and risk their proper respect. Don't judge your failures too harshly, and don't blindly worship risky successes. Third, extend your time horizon. Let compounding do its thing and don't interrupt it. And finally, save money not just to buy stuff but to buy back your own time and freedom.
Are you playing your own financial game or someone else's? Before you make your next big money decision, ask yourself this one final question. Are you playing your own financial game, or are you accidentally playing someone else's? Remember, the world is wildly complex, and social comparison is a massive trap. True wealth is the flexibility, autonomy, and peace of mind you build for your own future. So, figure out what enough means for you, stick to your own plan, and let time work its magic. Thanks so much for joining me on this explainer, and I'll see you next time.